And joining us now to discuss that is George Friedlander. He's Citigroup Senior Municipal Strategist. You've been a top-ranked strategist, George, for many, many years. When I worked at Citigroup, I remember reading your research on muni bonds. Tell me, what do you think? We've been waiting for the S&P announcements. A lot of people have been worried about what this will mean for municipalities. Do we see a big reversal in the price trend? We saw an outflow of money in the last weekly data.
The muni market is still in the process of forming its response to what has occurred. There are some indications of weakness. The leveraged closed-end fund prices dropped really sharply yesterday. But cash munis were kind of unchanged, and they're maybe a little bit weaker this morning. Frankly, munis are being held up by the sharp drop in Treasury yields that we just saw, and by very, very light supply. So the good news is that gives the market some time to kind of figure out what's going on rather than having to react instantaneously. I wouldn't be surprised to see a bit higher yields as this settles in, because when we get back some more supply, we're going to need individual investors to care. And we're not sure if they will yet.
When will the supply pick up? I mean, just like we've seen in corporate markets, right? Debt issuance has dropped as everyone's sort of holding their breath, waiting for some clarity. Well, we got the downgrade on Friday. Didn't really have an impact on treasuries, right? It sort of ironically had the reverse impact that you might expect. But when is that going to happen? When are we going to see issuance pick up? When are people going to say, or municipalities going to say, it's calm enough now for us to go ahead to market and borrow?
Yeah, I would guess we'll see a little bit better volume next week. But the big increase is probably not going to happen until after Labor Day. I mean, we're going into the doldrums, which would happen in any event. But we're going to see heavier volumes starting in the fall. I am confident of that.
All right, let's sort of connect the dots between the S&P downgrade. Okay, our long-term, the U.S. long-term credit rating now AA+.
Right.
There are many municipalities out there that have a AAA credit rating. Do you think S&P, I mean, they've said they're reviewing all these credit ratings now. Do you expect a number of downgrades to follow?
Yeah, they actually have a list out.
They have the full list out. We were waiting for the data all day yesterday.
They don't have an article that I can find that goes with the list.
Right.
But the list is on the S&P site now, and it's very long.
It is. Now, are there specific categories of bonds that have been hit the hardest, or that, you know, we talked about some that would have been backed by the government. Those might see an immediate downgrade. Are these general obligations? Are these revenue bonds?
Well, they're in a few categories. Certainly, anything that's directly secured by treasuries, like pre-refunded bonds, has gotten downgraded. Anything where there is a direct federal participation in the revenue stream, like some housing bonds, multifamily housing bonds, got downgraded. Beyond that, again, this list is just out, so we're still studying it, but it's kind of spotty. So, but I think it's really important to stress here, this is one agency. And while they're getting all the attention, there are two other agencies out there that didn't downgrade treasuries and aren't looking at a broad-based downgrade of their ratings on municipals. So I think to just focus on S&P, where all of the focus has been recently, would be a mistake in terms of the implications for municipal ratings.
What advice right now are you giving to clients in terms of rebalancing portfolios? We saw you said last week was the strongest week in munis that we've had all year, at least in terms of price performance, yet money is flowing out. Are people sort of, cashing in on their gains? They're trying to protect their profits, at least on the fixed income side, as they watch their equity portfolios drop?
We are seeing some signs of profit taking or reducing of positions. We watch the Municipal Securities Rulemaking Board feed very closely, and yesterday on a net basis it went negative for the first time since the beginning of 2007, meaning that there's a fair amount of selling going on. I don't think it's going to last very long. I think the market has experienced a shock, and it's going to take some time to settle in. We could see a little bit higher yields, especially when we get some supply. But I don't see a full-blown retreat from the muni market. In fact, with the positive slope of the muni yield curve, I think there are going to be some real values, especially when we get more volume. And as more volume comes in, we're going to be encouraging investors to lengthen their maturities because, let's face it, inside 5 years, you're getting really pathetic
yields. You're getting really nothing,
almost
but
close to zero.
Look, rates have to turn around at some point, right? That's what we all keep saying, some inflationary trends out there. So what's the longest maturity you like?
We'll go out to 15 to 17 years.
15 to 17 years.
Because the slope of the yield curve is so steep and because muni yields as a percentage of treasuries have really just jumped to practically to their highs for the year. So you have a cushion against at least some rise in treasury yields just because munis have gotten cheap all of a sudden.
Because they are so cheap relative to treasuries. But what isn't at this point? All right, George, thanks so much. Such a pleasure. That was George Friedlander from Citigroup.